Every investor should consider U.S. equities, and I'm not just saying that because I'm biased to my home country. The U.S. stock market is the dominant player in town. It's home to more than half of the global stock market and has been the world's powerhouse in financial markets since the 1800s. Simply put, the market is too big to be ignored. Over the past decade, U.S. larger companies in particular have been the darling of the investment world. Firms such as Facebook, Amazon, and Apple have become trillion-dollar companies, handsomely rewarding those that backed them. But in 2022, when inflation soared and interest rates suddenly started to rise, the share prices of some of these companies fell. So will the good times return, and what are the different ways people can invest in the world's largest market? 3 professional investors give us their views. First up is Julian Cook, U.S. equity specialist at Rowe Price, who says there are opportunities in large companies that are not so well known.
Now, the main attributes of the U.S. market is, very deep capital markets in private and in venture capital, world-leading innovation, largest single domestic market globally with a pro-business culture. Now, all of those elements, I think, give you lots of good reasons to consider the U.S. As an investment. I think it's possibly a little bit too cute, maybe, to sort of time exactly when you can be out and when you can be in. But I think as a long-term investor looking to get exposure to I think what are a pretty unique and unreplicatable set of attributes, the U.S. to me still looks like a very, very good place to invest money. So when I think about the U.S., I see opportunities in companies like these that may not be necessarily sort of household names to people sort of sitting here in the UK, but are very well established, very successful businesses, very reasonable valuations, we'd say, and very significant market cap sizes to boot.
Being such a dominant player in world stock markets, it's perhaps no surprise to learn that the U.S. market is also the most heavily researched by economists, investors, analysts, and fund managers all around the world. Because so many people are scouring the market, it can make it notoriously difficult for investors to spot opportunities before they're snapped up. Ben James, U.S. equity specialist on the Baillie Gifford American team, now gives his view on whether index funds or actively managed funds are best for investors.
I don't want to tell anyone how to build their portfolio, but there's a difference between the way we invest and the passive S&P 500 tracker, how that will behave. Essentially, I think there's a role for both active and passive investing in the US in people's portfolios, but it just depends on your risk tolerance and what you're trying to get. I do think in general that the US as a country generates the most and best growth companies out there. It's the most competitive, it's the most innovative, it's the deepest market in the world. So personally speaking, and this is not advice, I would hope that everyone has a small exposure at least to some of the most innovative US large cap growth companies. But what we do is try and find 30 to 50 of the best growth companies. We call them the exceptional growth companies in the US for the next 5 to 10 years. And a lot of them aren't in the index. So we're very different to the index. So if you take the S&P 500 as a sort of an example of as a representation of the wider market, we have an overlap of about 8%. So our portfolio will behave very differently.
But of course, the U.S. isn't just home to large companies, it's also home to innovative, growing smaller companies. Our final speaker is Cormac Weldon, manager of the Artemis U.S. Smaller Companies Fund.
So we think there is an opportunity to invest in U.S. smaller companies. And it's because, first of all, they haven't performed very well in recent years and have become much cheaper than their history. So there is a value argument to invest in U.S. companies. But really the strongest argument, and I as a portfolio manager in this portfolio represent, is that there are a number of different types of opportunities that provide diversification for investors. So one set of opportunities that we invest in is those that will benefit from all of the infrastructure spending, partly funded by the the government, but also funded by companies, which has been invested in domestic US. And really, US smaller companies are the best way of investing in those infrastructure themes. The other point is, and this is a common point for the US, is it's still the most innovative economy in the world. It produces these wonderful companies, many of them that start as small and grow much bigger in technology and healthcare. And a lot of those companies have also become cheaper in the last 18 months or so. So today, as I look at my portfolio, I see that there's lots of opportunity and lots of ways of benefiting from those themes I've talked about.
Investing in funds such as those highlighted in this video gives access to specialist fund managers who invest solely in the US day in and day out. These are managers with successful track records of finding opportunities as well as the potential to perform well over the long term. With the lion's share of the market, there are plenty of investment opportunities to add an extra layer of diversification in the US. Some would argue it's impossible to have a truly diversified portfolio without holding some investments across the pond. For more information on the funds mentioned in this video or to learn more about investing in US equities, visit fundcaliber.com, and don't forget to subscribe for more insight videos and weekly fund manager videos.